Will come to order. This hearing is in virtual format. A few reminders as we begin. Once you start speaking, there will be a slight delay before you show up on the screen. And to minimize any background noise, please click the mute button until it is your turn to speak or to ask questions or answer questions. You should all have one box on your screens labeled clock that will show you how much time is remaining. For witnesses, you will have 5 minutes for your opening statements. For all senators, the 5-minute clock still applies for your questions. At 30 seconds remaining for your statements and for your questions, you'll hear a bell ring to remind you that your time has almost expired. It will ring again when your time has expired. If there's any kind of technology issue, we'll move to the next witness or the next senator until it is resolved. And to simplify the speaking order process, Senator Kennedy and I have agreed to go by seniority for this hearing. So with that, let's begin. Good afternoon and welcome to this year's first hearing of the Banking Committee's Economic Policy Subcommittee. And thank you to Ranking Member Senator Kennedy for working with me and with my staff to help make this a very successful hearing. This subcommittee has a mandate to examine the economy and how to make sure it works for all Americans. Given this mandate, there is no better topic for our first hearing than student loans and their impact on racial justice, on borrowers, and on the economy. The student loan debt burden is massive, and it affects millions of families. About 43 million Americans owe more than $1.7 trillion in student loans. That's an average of almost $40,000 per borrower. Student loan debt takes a real bite out of personal finances. It can mean that borrowers can't afford a new car or can't get a mortgage or can't launch a business or can't start a family. This hurts them individually, but it also hurts the whole economy. The burden is so heavy that when the pandemic hit, Republican and Democratic policymakers recognized that loan payments would just sink families. So first President Trump and then President Biden paused student loan payments and canceled accumulating interest. It was a smart move, but in a few months, those payments are scheduled to go up again. America is facing a student loan time bomb that, when it explodes, could throw millions of families over a financial cliff. The average borrower will have to start paying nearly $400 a month to the government instead of spending that money out in the economy. Student debt also makes racial disparities in America even worse. Compared with white students, Black and Hispanic students are forced to borrow more money to go to school, borrow more money while they're in school, and have a harder time paying off their loans after graduation. I'm just going to do one statistic around this. 20 years after taking out their student loans, median white borrowers owe about 6% of their original amount. The end is in sight. But after 20 years, median Black borrowers still owe 95% of the original amount they borrowed. Their path seems to stretch on forever. We can help. Leader Schumer and I have urged President Biden to address this economic problem by using his existing authority to cancel $50,000 in student debt for each borrower. New data I obtained from the Education Department reveals the benefits of debt cancellation. The data show that if we cancel $50,000 in student loan debt, 36 million borrowers would be completely relieved of their debt burdens. A significant number of these borrowers who would finally be free of student loan debt, 3.1 million people, have already been carrying their debt burden for over 20 years. It's time to act now. Republican and Democratic presidents have a long history of using their statutory authority to cancel student loan debt. President Obama used this authority to cancel all debt for tens of thousands of students. And President Trump used this authority to cancel some debt, accrued interest, for 37 million federal borrowers. Canceling $50,000 in student loan debt would also help close the black-white wealth gap among borrowers by 25 points. For Latinos, the gap would close by 27 points. This is the single most powerful executive action President Biden could take to advance racial equity and give everyone in America a chance to build a real future. So I want to thank all of our witnesses for coming today. I look forward to hearing your testimony. And with that, I'll turn to Ranking Member Senator Kennedy for your opening remarks.
Thank you, Madam Chair. I will try to be brief. We have a distinguished panel of witnesses that I would like to hear from today. I think this is a timely subject. I have many questions, and I hope to get educated today. Why student debt? Why not credit card debt? Why not automobile loan debt? Why not mortgage debt if we're going to forgive debt? How do we be fair to all Americans? What role, if any, did our universities play in the accumulation of all of this student debt? I'm not sure that this is the right place to address education policy, but if anybody knows the answer, I would like to know why some college textbooks cost as much as I paid for my first car. And these are the kind of issues that I hope that we can address today. What are the demographics of the people who owe us, who owe student debt? Is there really I'm not suggesting there isn't, I don't know. Is there a racial gap? How equitable is it to ask taxpayers who haven't gone to college to pay for those who have gone to college? These are the kind of issues that I hope we can address today. And as I say, my mind is open and I'm looking forward to hearing the answers. And with that, I will turn it back over to our distinguished chair, with whom I have worked closely setting up this hearing, and I enjoyed every minute of it.
Well, thank you very much, Senator Kennedy, and I've enjoyed working with you, and I appreciate it. So now I'm going to introduce today's witnesses. We have two panels today. In the first panel, in the first panel here, I am pleased to introduce my friend, Congresswoman Ayanna Pressley, who represents Massachusetts' 7th Congressional District and who has been a powerful voice for borrowers. I am also pleased to introduce Congressman Byron Donalds, who represents Florida's 19th District. Welcome, Congressman Donalds. It is good to have you here. And I'll go ahead and do the rest of the introductions. For our second panel, we have Massachusetts Attorney General Maura Healey, who has helped thousands of borrowers escape unfair debt. We have Dr. Dominique Baker, an assistant professor of education policy at Southern Methodist University. We have Ms. Daramir Perez, a middle school guidance counselor in the New York City Public Schools. We also have witnesses from two of the country's largest student loan servicers with us today. Mr. James Steele, who is president and CEO of the Pennsylvania Higher Education Assistance Agency, otherwise known all around the country as PHIA. And we have Mr. John Ramondi, who is president and CEO of Navion. Welcome to both of you. In addition, we have Dr. Beth Akers, a senior fellow at the American Enterprise Institute, Dr. Constantine Yannelis, an assistant professor of finance at the University of Chicago Booth School of Business, Mr. Alex Holt, a policy analyst at the Committee for a Responsible Federal Budget. And then finally, we have Dr. Adam Looney, the Executive Director of the Mariner S. Eccles Institute and Professor of Finance at the University of Utah. I want to thank all of you for being here with us today. And to begin our first panel, Congresswoman Presley, you are recognized for 5 minutes.
Good afternoon, Madam Chairwoman, Mr. Ranking Member, and distinguished members of the committee. Thank you for the opportunity to testify here today. As lawmakers, we are in a position to fundamentally change the lives of the people we represent with the stroke of a pen. And that is why we must center the people in the work we take on together. When the history books are written, this moment will be defined by the actions we took or failed to in the face of unprecedented crises and economic pain. I've become all too familiar with the gentle tug of my sleeve or the panicked expression as I meet the eyes of someone drowning in student debt. The grandmother who is still paying off student loans, the young parent who can't afford childcare, rent, and her student loan payments, the teacher who fears losing his teaching license because he can't come up with that monthly student loan payment, not even the minimum. The student debt crisis is not naturally occurring. This crisis was crafted in these hallowed halls. Policy decisions were made that ensnared generations in the student debt trap. Congress crafted through policy and deregulation an economy where college degrees are increasingly essential for economic survival, but their sticker price is far too out of reach for most families. Make no mistake, despite the dominant narrative, the student debt crisis has always been both a racial and economic justice issue. In the city of Boston, the city my family calls home, the average median wealth of a white family is $247,500, while the average median wealth of a Black family is $8. $8. That is not the result of ingenuity, work ethic, or initiative. That is the result of precise and intentional policy decisions made in the halls of this institution and at every level of government. Discriminatory policies have systemically denied families of color the opportunity to own a home or to build wealth. So for our students who don't have the benefit of intergenerational wealth, specifically our Black and brown students, signing on the dotted line for those student loans have been the only way to pursue a degree. That was certainly true for me. I know what it is to lie awake at night, panicked over student loan and default, despite working 12-hour days. All people who call this nation home deserve the freedom to build a full life, to pursue their unique gifts and contribute to every sector of our economy. We have to take bold action to address the inequities and disparities in our country and use every tool available to provide our communities with the critical relief they so desperately need. Our nation and this committee are facing an economic crisis. Canceling student debt by executive action is one of the most effective ways President Biden can provide sweeping relief to millions of families while helping to reduce the racial wealth gap and to lay the groundwork for an equitable and just long-term recovery. Congress gave the president the authority to do so through the Higher Education Act. I implore him to use this authority in the pursuit of economic and racial justice. In a matter of months, student debt payments will resume for millions of people across this country. Families who are now struggling with pandemic-related financial stress through no fault of their own will have an additional bill at their doorstep. So as we work to ensure an equitable and prompt recovery to the current economic crisis, let us not repeat the mistakes of the past. Let us be intentional and precise. Student debt cancellation is efficient and effective. It will provide millions of families across this nation with economic relief and opportunity. Student debt cancellation is good economic policy because it invests in the people. That's why Senator Warren, myself, and Majority Leader Schumer and our colleagues have a resolution that lays out a pathway for President Biden to cancel $50,000 in student loan debt. With the stroke of a pen, he can provide direct relief to tens of millions of families. I'll close today where I began, centering the people in their own words. A constituent of mine recently shared their story. We are a family of 5 with a child with disabilities, he said. I have over $100,000 in student debt. I put myself through my bachelor's and master's with children. I've had to file bankruptcy because of my student debt. Please don't forget about us in this process. Please think of us when talking about debt relief. Lord knows it would change our lives. The economic anxiety and pressure caused by student loan debt is an experience far too familiar to too many. That father is one of millions calling on us to act. I implore this committee and President Biden to listen to them. Thank you.
Thank you very much, Congresswoman Presley. Appreciate your being here. Congressman Donalds, you are now recognized for 5 minutes.
Chairwoman Warren, Ranking Member Kennedy, thank you for inviting me to testify in front of the committee on the important discussions surrounding student debt. Let me begin with one word of absolute truth. Nothing in this world is free. Someone is always paying. Even with charity, if a doctor sees a patient and decides not to charge them, then the doctor himself pays the debt through services provided without being compensated. When our government doles out $2 trillion in emergency spending like we did last month, no matter how good or noble the cause may seem, it is either this generation or the next that must pay the tab. Money that this government spends does not disappear. It's why right now we are nearly $30 trillion in debt. Each time Washington spends money, it adds up, and there will come a day when the bill comes due, and it won't be pretty and may ultimately be the undoing of this republic if Congress is not more prudent in how it spends other people's money. On the topic of today's hearing, Democrats in Congress and the president himself have made it clear that of their desire to cancel student loan debt. This, while clearly a political ploy meant to keep Democrats in power by hoodwinking the American people into thinking their debt won't impose a cost in society, will not solve the problem that all of us recognize needs fixing. If this policy moves forward, it will result in even higher tuition costs for students who plan to go to college in future years, with disastrous collateral damage elsewhere in the economy, including and especially to low-income families and African-American communities. Who should we suppose would pay the hundreds of billions of dollars that are currently owed? Do we force colleges and universities to repay money paid to them for the asset of a college degree? Where would the universities get the funds to pay if students who fund their livelihoods in exchange for a degree so that they can get out and get a job don't actually have to pay for the invaluable education they receive? Or perhaps the wealthiest among us should once again be called to pay more. These are the very job creators who newly graduated college students will need to hire them. If we start taking our money from the rich, this will not save. If we start taking more money from the rich, this will not save the problem. Lastly, do we call upon people who did not go to universities to pay for those who did? Ultimately, it is very likely that this is what the Democrat proposal will do, forcing individuals at the lower end of the income spectrum, which tends to be more Black than white, to pay for privileged students with their liberal arts degrees. A study conducted just last year found that under a universal loan forgiveness policy like the one the president and Democrats in Congress have proposed, individuals at the top of the earning decile will receive more than 5 times the loan forgiveness as an individual in the lowest income bracket. Furthermore, the study determined that households in the top 30% of the earnings distribution will receive almost half of all dollars forgiven. I'm no stranger to student loan debt myself. In fact, at this very moment, I still have student loans and I'm paying them back each month. I wouldn't be here without my education from Florida A&M University and Florida State University, from which I am incredibly grateful. There is no question my education was worth far more than what I am still paying back, and it is my responsibility to pay for it. But as you know, not everyone who attends college ends up with a degree that is worth the dollars spent attaining it. Time is too short to deliberate here today what types of degrees are worth more than others. But it is time we look to ensure that public dollars spent on the education of our people have a positive return on investment. That's not to say that everyone should not be able to choose whatever field of study they desire. But if public dollars are involved, there needs to be a correlation to the economic good of the individual. That said, the priority of this Congress and this committee should be on controlling the ballooning costs and expenses of colleges and universities in our country. A 2017 study by the Federal Reserve Bank of New York found that for every dollar of subsidized federal loans, tuition increased 60 cents. If the ultimate goal is to increase the cost of going to college, the Democrat plan will do just that. This is irresponsible governing, and it is something we must all fight against. Once again, I am grateful to have been invited to participate in today's hearing, and I encourage all of us to look at the very real problem of the rising costs of tuition and seek to address this in a way that is not a short-term fix, but a real long-term solution. Thank you.
Congressman Donalds, thank you very much for being here with us today. Appreciate both of you showing up. And now we're going to proceed to our second panel. Attorney General Healy, you are recognized for 5 minutes.
Mr. Ranking Member. Okay, I'm on. Chair Warren, Mr. Ranking Member Kennedy, and members of the subcommittee, thank you for inviting me to testify today. I am Maura Healy, the Attorney General in Massachusetts, and I appreciate the opportunity to share some of my insights as to why debt cancellation is really so essential to aid struggling borrowers and to boost our economy and help close the racial wealth gap. The Higher Education Act was intended to keep the college door open to all students, regardless of socioeconomic background. But today, millions of hardworking Americans are stuck in a quagmire of student loan debt. Now, my office has been on the front lines of this $1.7 trillion and growing crisis, fighting on behalf of student borrowers here in Massachusetts. And here's what we've learned. We've learned that the student loan system is fundamentally broken and taking a devastating toll on countless Americans. It's a system that's enabled for-profit schools to deceive and to defraud vulnerable students, particularly targeting students of colors, a system that has recklessly saddled parent borrowers with loans that they can't possibly afford to repay, a system that's failed to deliver on the promise of loan forgiveness to thousands of public servants, and a system that's hollowed out the futures of millions of young people and left them with broken dreams and a lifetime of insurmountable debt. Loan servicers who are paid with taxpayer money have failed to help borrowers access repayment and forgiveness programs, rendering these programs inadequate to address the current crisis. The Department of Education has the legal authority to provide necessary debt relief and should do so swiftly and aggressively. Today, nearly a quarter of borrowers are in default on their federal student loans. We've seen borrowers forced to delay traditional life milestones, getting married, starting a family, buying homes or cars, starting businesses. They lack the fundamental financial stability to weather a recession and are more likely to enter retirement with little or no savings. The burden, of course, of student debt falls disproportionately on people of color. Studies show that Black students must borrow more frequently, graduate with more debt, pay off their student loan debt at a slower rate, and have much higher rates of default. 4 years after graduating with a bachelor's degree, Black college graduates have nearly $25,000 more in student loan debt than the typical white graduate. Now, for-profit schools have had a particularly large impact on students of color. While Black and Latinx students together make up about 36% of all students enrolled in undergraduate study, they represent more than half of undergraduates at for-profit colleges. I come here today having established a student loan assistance unit as soon as I was elected in 2014. And addressing the student loan crisis has been one of my office's top priorities. This unit offers an inside view into the problems that borrowers and their families confront every single day, the complexities of the systems they're forced to navigate. Many call us, of course, after reaching a dead end with their student loan servicer. My office receives nearly 4,000 requests a year, hotline calls, emails, other requests for assistance. And we work to do the best we can to generate refunds and savings and help these students get into better plans. But it's too much, it's overwhelming. We've also taken actions to hold student loan servicers accountable, and protect borrowers' rights to obtain loan forgiveness. In 2017, we brought a case against FIA, formerly known as the Fed Loan Servicing Entity. We alleged that it mismanaged the Public Service Loan Forgiveness Program and income-driven repayment plan applications. We spent 3.5 years of hard-fought investigation, litigation. We ultimately reached a settlement that requires FIA to conduct individual loan account audits for every Massachusetts federal student loan borrower who submits a claim. This could require over 200,000 reviews for Massachusetts alone and provides borrowers with loan account corrections and monetary payments. State attorneys general and the CFPB have also filed lawsuits against Navion, alleging that rather than taking the time to counsel borrowers and to help them enroll in affordable IDR plans, Navion instead steered borrowers into costly long-term forbearances that resulted in hundreds of millions of dollars being added to their loan balances. We've also alleged that Navion made millions of dollars in high-risk loans to students at predatory for-profit colleges. My office has brought actions against over a dozen of those for-profit schools that lured students in with false promises and left them with worthless degrees, few job prospects, and insurmountable debt. As a result, the Obama administration granted tens of millions of dollars in borrower defense discharges to thousands of Massachusetts students who attended Corinthian or the American Career Institute. And yet today, many more discharges are still owed to borrowers.
Attorney General Healy, I appreciate it, but we're going over 5 minutes here. How about if we submit the rest of your testimony for the record? And we'll have some questions if that's all right.
I appreciate that. Thank you.
Thank you very much. And I'm now going to go vote. So I'm going to hand over the gavel to our ranking member, Senator Kennedy, who I think will be calling on Dr. Baker.
Yes, can you hear, Madam Chair?
Yes. It's all
Dr.
yours.
Baker. Dr. Baker.
Thank you. Y'all can hear me? Perfect. Chair Warren, Ranking Member Kennedy, and members of the subcommittee, thank you for inviting me to testify. As a scholar of education policy, I am honored to discuss the evidence on student debt and its role in the larger economy, especially its impact on racial justice. If there were equitable returns to a college degree, all college graduates should be able to access a more economically prosperous life. But racial wealth gaps complicate this narrative. For instance, according to national data on bachelor's recipients, 4% of white graduates defaulted on their loans, compared to 21% of Black graduates. Even more startling, Black graduates defaulted at a higher rate than white students who left higher education without a degree. This means that Black college graduates actually struggle to repay their student loan debt more than white students without degrees. This example of racial disparities in student loan repayment is not due to some innate issue within Black people. Instead, the burden of student loan debt disproportionately falls on these students due to centuries of structural forces shaped by the deliberate decisions of those in power. Structural racism has denied Black families the ability to build wealth to pay for college, while also shaping their residential and K-12 experiences. Together, this means that Black students are more likely to enroll in either systematically underfunded or outright predatory colleges that saddle them with high debt, little chance of earning a degree, or both. Then, those same students face a discriminatory labor market that pays them less than their peers for the same amount of education, equivalent in 2016 to an 8% pay cut for the median Black graduate. At the same time, they must also navigate other structures that impede their ability to accrue wealth. This example underscores why it is necessary to think about the ways that race, racism, and student loans work together to create an untenable situation in the United States, particularly for borrowers of color. Canceling a portion of student loans is not a panacea for the issues facing college affordability or the larger repayment process. Additional federal policy solutions must work to create a high-quality, affordable higher education system, hold colleges, universities, and states accountable for contributing their share, and overhaul the current repayment system. Yet, student loan cancellation can be a powerful supplement to these other reforms. True reform necessitates that government works to both overhaul the system and provide relief for past policy failures. For the student debt crisis, loan cancellation is part of that relief. Research shows that a reduction in an individual's student loan balance can increase their income. It can also decrease constraints on occupation choices, the amount of debt held, and the share of delinquent credit accounts. This evidence, combined with recent research showing that other forms of consumer debt relief can strengthen employment levels in the United States, signals that student loan debt cancellation could be a boon to the overall economy. The key benefits of debt cancellation are its simplicity and transparency. One reason for having an inclusive policy is that broad relief would reduce administrative burdens. These burdens include the cost for individuals to prove they deserve help and disproportionately deter individuals of color from accessing benefits for which they qualify. Further, simulations of loan cancellation often fail to include racial breakdowns for the benefits of the policy. For example, some simulations assume that the risk of missing payments on student loans is completely random, or that earnings for people of color grow at the same rate as white individuals, both of which are unlikely in practice. As a result, such simulations likely underestimate the benefits of loan cancellation on closing racial wealth gaps. For decades, the federal government has made students an implicit promise. If you borrow this money and work hard in college, you'll find a good job and be able to pay it back. Far too often, that promise is broken. We can and should acknowledge this reality by taking concrete steps to reduce the burden for those who simply did as they were encouraged on their quest for economic prosperity. It is an honor to be here today, and I'm happy to answer any questions you might have. Thank you.
Thank you, Doctor. Next is Ms. Perez.
Yes.
Ms. Perez, the floor is yours.
Thank you. Hello, Chairwoman Warren, Ranking Member Kennedy, and members of the committee. Thank you for giving me the opportunity to participate in today's hearing and to share my story. My name is Darimir Perez, and I am a middle school guidance counselor in Washington Heights in New York City. I immigrated to the United States from the Dominican Republic with my siblings when I was 13 years old, and unfortunately, my father passed away soon after. As a result, my 18-year-old sister dropped out of college to help support the family. Her sacrifice enabled me to become the first member of my family to graduate from college. I was very aware of the cost of college, turning down partial scholarships to attend private universities. Instead, I attended City College of New York and was able to graduate from undergrad with no loan debt. I got married and started a family. I'm the proud parent of twin children who are now 18 years old. When my children were young, I began working as a paraprofessional in New York City schools. I noticed the need for bilingual counselors and the difficulties parents experience. I was reminded of my own struggles navigating the school system. It inspired me to provide consistent support to students while holding them to high standards, an opportunity I had not received. Knowing that I wanted to work in schools and being fully aware of all my responsibilities as a mother and the first college graduate in my family, I needed to be careful about student loans, so I did my research. Teach.org is a website led by Microsoft and the US Department of Education. I used the website to find a local college where I could get my graduate degree and that will make me eligible for student loan repayment assistance. I graduated with my master's degree in spring of 2010 with about $50,000 in student loans. I found a full-time job in New York City schools and was promised loan repayment assistance from a city program. More than 10 years later, I still have about $35,000 worth of loans from my own education, And last year, I took out PLUS loans to help my children attend college and have a real American college experience. How is it that more than 10 years later, having put money toward my loans every year while working full-time in public service, I still have so much debt? Every time I call my loan servicer and try to explain I needed a different payment plan because I couldn't afford it, they rush me off, offering forbearance to eliminate my headache. And to be honest, it was like a magic pill I took without knowing the side effects. The loan pause during the last year has made a great difference in my life. I was finally able to fully repay one of my loans, totally repay it. I was also able to pay off some medical bills, help my mom and family, put some money towards my kids' education, and cover a few current medical bills due to COVID-19. Having this student loan debt has affected my life in many ways. I had always wanted to have 3 kids, to buy a house in a peaceful area, to enroll my twins in all the extracurricular activities they were interested in, and to have the choice to not take on extra work so I could spend more time with my family. But those things were not an option with my loans. I'm a college graduate, and I can't even afford to send my own kids to college. My friends who never went to college, their kids are better off than mine. Even though I did everything right for my own kids, supporting them and keeping them focused, achieving top grades, and working towards positive things in a neighborhood with a lot of negative distractions, I sadly don't feel that they are better off than I was because of the cost of college and student loan debt. I truly believe that education can change lives. That's why I've stayed in my job. But having some relief from my student loans will make a wonderful, positive difference in my life. But please know that I'm not speaking only for myself. I am one of hundreds of thousands of public servants who selfishly decided to work towards creating a positive change in our society and support our communities. Yet, we are struggling to better ourselves and support our own families. Thank you for taking the time to listen to my story today. I will gladly answer your questions.
Thank you, Ms. Perez. Who's next? Mr. Ramondi?
Thank you, Senator. Good afternoon, everyone. Chairperson Warren, Ranking Member Kennedy, and members of the subcommittee. I am Jack Ramondi, President and CEO of Navion, a leader in education loan management, providing vital services to students and college graduates. I am grateful you are holding this hearing and appreciate the opportunity to participate. Federal student loan servicers like Navion begin to work with students only after they have borrowed. After Congress has set the loan terms, the college has set tuition, and the loan proceeds have been spent. We work hard to help students realize the benefit of their education. We also help struggling borrowers navigate today's complex loan repayment options. The value of higher education for individuals and society is without question. Decades of data show a college degree is still among the surest paths to prosperity. The median bachelor degrees recipient earns more than $2,000 more per month and typically experiences half the rate of unemployment compared to peers with a high school diploma. The value of a college education was particularly clear this past year during the pandemic. We also know higher education is critical to helping address the racial wealth gap. Black Americans who hold degrees are more likely to be employed, earn more in their jobs, 1.8 times more, own a home, and express higher levels of optimism about their future. For many, the system works. Indeed, at Navion, 500,000 borrowers each year pay off their loans in full. Our over 45 years of experience and data insights have helped us design solutions to help people avoid default and pay off their loans. In fact, borrowers who are serviced by Navion are 34% less likely to default than borrowers serviced by other companies. This success extends to African American borrowers. For example, alumni of historically Black colleges and universities They were 39% less likely to default when their loans were serviced by Navion. However, while many have benefited from a college degree made possible by student loans, the system does not work for all. Through my regular call listening, I hear the challenges some borrowers face, including people who left school with debt but no degree, or student borrowers who discovered too late that the value of their education did not match the debt they took on. And even for many people of color with a college degree, the racial gap has widened. There are steps that can be taken to fix the system and address the unfairness that pervades it, especially unfairness that creates barriers for people of color. Navion stands ready to work with policymakers, members of Congress, and the Biden-Harris administration to bring about important reforms. Today, I'd like to raise 3 proposals that would help current borrowers who feel trapped by their debt and that would ensure better outcomes for tomorrow's borrowers. First, we should increase assistance to those who have borrowed in the past but did not attain the hoped-for outcomes. According to a 2016 Obama administration report, 2/3 of all the defaults in the federal program are from students who borrowed less than $10,000, generally an indication of leaving school without a degree. Reform should also include debt forgiveness for borrowers who have been in default for more than 10 years, and we should make federal and private student loans dischargeable in bankruptcy. Second, we need to implement faster forgiveness programs for current and future borrowers. We propose replacing today's 9 different income-driven repayment plans, which most experts agree are too complex and difficult to understand, into a new single forgive-as-you-go repayment plan. Unlike today's complex programs that defer any forgiveness for 10 to 25 years and often lead to loan balances increasing materially in the interim, Forgive as you go would reduce balances each month as borrowers make payments they can afford. Third, incoming college students should receive better support before they borrow and while they are in school to help them achieve their and our goal of graduation. This support should help students and their families understand the total cost to earn their degree, the amount they need to borrow, and how their program of study and career choices will help them repay that debt. My written testimony details these proposals and other steps to help student loan borrowers. I thank you for this opportunity, and I look forward to your questions.
So I'm back, Senator Kennedy, and I want to say thank you, Mr. Ramondi. And Mr. Steele, you're now recognized for 5 minutes.
Chair Warren, Ranking Member Kennedy, and members of the subcommittee, thank you for the opportunity to speak with you today. FIA was established by the Pennsylvania General Assembly with the primary mission of creating affordable access to higher education. With a union workforce, FIA offers student aid services throughout the Commonwealth. We are a contracted federal student loan servicer and an administrator of Pennsylvania's student aid programs. Unlike other servicers, FIA engages in loan servicing because it aligns with and supports our public service mission. Most importantly, the funding of our need-based grant awards. Such awards play an important role in decreasing the need for students to borrow to pay for college. We have learned that Pennsylvania grant recipients, who are also eligible for Pell Awards, borrow nearly $9,000 less over 4 years of education. FIA also uses its earnings to support outreach initiatives, much of which are focused on helping students make wise choices early in their planning process so they can avoid unnecessary debt. This outreach is more important now than ever as student debt levels continue to rise, which unfortunately are higher for Black graduates than they are for white graduates. According to a 2016 Brookings study, Black students with a bachelor's degree owe an average of $7,400 more than their white counterparts. FIA encourages all students to avoid unnecessary loan debt and has been leading efforts in the Commonwealth with FAFSA completion events, online tools, and other resources. FIA also administers several Pennsylvania programs specifically to assist minority students and those from underserved backgrounds. This includes the Higher Education of the Disadvantaged Program, or Act 101, which enhances both the education opportunities and achievements of undergraduate students. FIA co-administers the Cheney Keystone Academy program, which provides scholarships to gifted students enrolled at America's oldest HBCU, Cheney University. Additionally, FIA co-administers the Bond Hill program, which provides scholarships to students from Cheney University and Lincoln University, another of Pennsylvania's HBCUs. As a loan servicer, we began servicing federal student loans in 2009. We are required to adhere to the laws as written by Congress and rules set forth by the U.S. Department of Education. It is not within FIA's purview to unilaterally change or override program rules. However, we regularly advocate on behalf of the customers we serve with policy changes that could improve the experiences and outcomes of these customers. The Pslf program was established in 2007 and establishes an opportunity for the balance of a borrower's federal direct loan to be forgiven after 10 years of qualifying payments and qualified employment. While the program was created in 2007, the first servicing contract was not awarded till 2011, at which time FIA became the primary servicer. Prior to this, public information was limited to what was written in the law. There was no guidance available from the Department of Education to assist borrowers to ensure that they were meeting the steps they needed to for forgiveness. At program inception, 75% of all federal borrowers had FELP loans, which were by statute ineligible for PSLF. It was only with the phase out of FELP in the 2010-2011 academic year that all federal borrowers became eligible for forgiveness. Unfortunately, some of the headlines surrounding the program claim that because applicants have been denied forgiveness, FIA's servicing of the program was broken. In fact, only about 5% of interested PSLF borrowers have been in repayment of a qualified federal direct loan for 10 years while working for a qualified employer. Approvals have recently begun to increase as more borrowers have met the 10-year mark. And by this time next year, we expect to see over $1 billion in loan forgiveness in the program. As I conclude my remarks, I want to express FIA's desire, not just as a federal loan servicer, but as a state-based aid agency, to be part of the solution to reducing student debt levels. On behalf of FIA's workforce, including our 1,200 union-covered employees, thank you for the opportunity to appear here today.
So thank you very much, Mr. Steele. Dr. Akers, you are recognized for 5 minutes.
Thank you. Chair Warren, Ranking Member Kennedy, and members of the subcommittee, thank you for inviting me here to share my assessment of this important issue. The volume of student loan debt in the economy has now surpassed $1.6 trillion, which is an alarming milestone. With 45 million Americans now holding student debt, this has rightly become a national concern. When considering the impact of student debt on individuals, it is important to recognize the appropriate counterfactual for the comparison. While borrowers would unequivocally be better off if they didn't have to repay their debt, most are better off with debt and a degree than they would be if they'd not pursued higher education. Graduates with bachelor's degree programs have an average of $30,000 in debt. Research suggests, however, that their degree will earn them an extra $2.8 million over the course of their lifetime through a combination of higher wages and less frequent unemployment. For the typical borrower, access to student debt through the federal loan program creates an opportunity for economic mobility that would otherwise be unavailable. Some students, however, are left worse off financially. These borrowers often fall into two categories: those who start but don't complete a degree, and those who complete a degree but find that it doesn't deliver employment opportunities that justify its cost. Low-income, first-generation, and minority students are disproportionately represented in these groups. For example, in 2019, Black students made up 21% of the population at for-profit institutions, which have tended to produce poor outcomes, even though they make up just 13% of students enrolled in public colleges. Ideally, borrowers who find their loan payments unaffordable due to a lack of earnings would take advantage of the existing safety nets, namely the set of income-driven repayment programs. But evidence suggests that the safety net created by these programs is falling short. This is because IDR is administered through a complex variety of programs. The result is a system that is excessively difficult to navigate, with many borrowers not even aware of the benefits available to them. Some might argue that these facts justify a blunt intervention, like mass loan cancellation, which would not require borrowers to jump through hoops. But that's not the case. The complexity of the current safety net is not due to the income-based eligibility criteria. It is complex because of how it was created, through a combination of piecemeal, non-conforming policy changes. In addition to being an unnecessarily blunt fix, widespread student loan cancellation would create additional problems. The distortion of incentives would likely exacerbate the problems of ballooning loan balances and rampant tuition inflation. If mass loan cancellation were implemented, we'd likely find ourselves having the same conversation again, but with larger balances to contend with. Not only would widespread loan cancellation create moral hazard, but it would also deliver more benefits to well-off borrowers than to needy ones. Dr. Yanellis' research has indicated that a comprehensive loan forgiveness program would deliver 10 times more benefits to borrowers in the top 10% of the income distribution than it would provide to borrowers in the bottom 10% of earners. It would be a boon for rich, highly educated, and mostly white borrowers. Higher education is an essential mechanism for social mobility in this country, so it is crucial that our financing system protects borrowers from ruin. Aspiring students shouldn't have to fear that college will leave them worse off financially than where they started. And at the same time, those who benefit generously from college and access to the federal loan program should be expected to repay their debt to taxpayers. We can achieve this by simplifying the student loan safety net so that it can be more readily understood and navigated. The current set of IDR programs should be replaced with a single, universal program, and the application process should be streamlined. Since investments in education, on average, provide a net positive return, spending on education is generally a wealth-enhancing activity, both individually and collectively, even taking into account the cost of borrowing. I urge you all to consider that nuanced reforms might better serve disadvantaged students and accomplish our collective goal of supporting this pathway to economic prosperity. Thank you for the opportunity to give testimony in this important hearing. I look forward to answering your questions.
So thank you very much. And now we have Dr. Yanellis. You are recognized for 5 minutes.
Dear Chair Warren, Ranking Member Kennedy, and distinguished members of the committee, thank you for inviting me and the opportunity to testify today. Education is the single highest return investment most Americans will make, and getting our system of higher education finance right is of fundamental importance to the American economy. A key point that has to be made whenever discussing student loans is that the outcomes of borrowers vary widely. It is undeniable that a significant number of borrowers are struggling and are sympathetic candidates for some kind of relief. At the same time, the majority of borrowers end up earning high amounts and do not have difficulties repaying their loans. The core of the problem in the student loan market lies in a misalignment of incentives between students, schools, and the government. This misalignment comes from the fact that borrowers use government loans to pay tuition to schools. If borrowers end up getting poor jobs and they default on their loans, schools are not on the hook. Taxpayers end up paying the costs. How do we address this incentive problem? One common proposal is some form of blanket student loan cancellation. This is an extremely regressive policy. It provides more assistance to higher income rather than lower income borrowers. This is primarily because people who go to college tend to earn more than those who do not go to college, and people who spend more on their college education, like those who attend medical or law schools, tend to earn more than those who spent less on their college education, like dropouts and associate's degrees holders. My own research, which is joint with Sylvain Catherine at Wharton, shows that most of the benefits of universal loan cancellation would accrue to high-income individuals. Individuals in the top 20% of the earnings distribution would receive 6 to 8 times as much debt relief as individuals in the bottom 20% of the earnings distribution. These basic patterns are still true for policies that limit forgiveness up to $10,000 or $50,000. That student loan cancellation is regressive is the consensus of economists. The panel of prominent economists run by the Initiative on Global Markets at the University of Chicago asked economists whether having the government issue additional debt to pay off current outstanding loans would be net regressive. The results of the survey were telling. Not a single economist disagreed with the idea that student loan forgiveness was regressive. This is because the facts are clear on this issue. To borrow a phrase commonly used, the science is settled. Student loan forgiveness is a regressive policy that mostly benefits upper and middle class individuals. One of the topics of this hearing is the effect of student loan forgiveness on racial inequality. Racial inequality is a very important topic. However, student loan forgiveness is not the way to close this important gap. The policy would cost about 1.7 trillion and shrink the racial wealth gap by about 3%. Surely there are more effective ways to invest 1.7 trillion if the goal of policymakers is to close the racial wealth gap. Now, how can we provide relief to borrowers who need it while avoiding making large payments to well-off individuals? There are a number of policy options for legislators to consider. One option to provide relief is to bring back bankruptcy protection for student loan borrowers. Another option is expanding the use of income-driven repayment, or IDR. These are plans that link a borrower's payments to their incomes. Depending on the plan, after 20 or 25 years, remaining balances are forgiven. Put simply, higher income people pay more and lower income people pay less. IDR is thus a progressive policy. There have been problems with the implementation of IDR plans in the United States, but the problems are fixable and some have been fixed by recent legislation. Many countries, such as the UK and Australia, successfully operate IDR programs that are administered through their respective tax authorities. While providing relief to struggling borrowers is important, policymakers can fix the larger underlying problem by directly aligning incentives between schools and borrowers. For example, Brazil has had similar problems with their student loan program. Recently, they gave schools skin in the game and required them to pay a fee based on dropout and default rates. Making revenues go directly to schools from IDR plans or income share agreements where individuals pay an uncapped portion of their income could also help align the incentives of schools, students, and taxpayers. In closing, I want to stress that federal student loans are an important part of college financing and intergenerational mobility. The root of our student loan problem is a misalignment of incentives. Since the student loan problem has been so slow moving and continuous, I like the analogy of a frog slowly boiling in a pot of water over a flame. Policies like student debt cancellation are not extinguishing the flame. They aren't fixing the underlying incentive problem. All you would be doing is moving the frog into a slightly cooler pot of water. And if we don't fix the core of the problem, even if you forgive $50,000 of debt for current borrowers, balances will continue to grow, and we will be having another hearing with a similar theme in 10 or 20 years' time. Thank you.
Thank you very much, Dr. Yanellis. And Mr. Holt, you're now recognized for 5 minutes.
Thank you. Chair Warren, Ranking Member Kennedy, and members of the subcommittee, thank you for inviting me to testify. The Federal Student Loan Program is one of the country's most successful tools for expanding access to higher education and boosting lifetime earnings. But the program definitely needs improving. And in doing so, we should consider a number of worthwhile goals already being discussed, including supporting the economic recovery, stemming the rise in the cost of college, reducing the racial wealth gap, and supporting low-income individuals trying to get ahead by getting a college degree. Unfortunately, blanket debt forgiveness would do little to achieve these goals, particularly in light of its huge costs. I want to make 3 key points. First, blanket debt forgiveness offers a very low bang for your buck in terms of stimulating the economy and supporting the economic recovery. Second, broad debt forgiveness could create a moral hazard that increases borrowing and reduces incentives for schools to contain costs. Finally, blanket debt cancellation is very expensive. Given the national debt is already approaching record levels, we shouldn't spend hundreds of billions or over $1 trillion on such a poorly targeted policy. So first, economic stimulus. In November, the Committee for a Responsible Federal Budget estimated a multiplier for complete debt cancellation of between 8 and 23 cents on the dollar, which is very low relative to other relief efforts. And that was before the vaccination started and Congress enacted an additional $3 trillion of COVID relief. The multiplier today would surely be on the lower end of what we estimated and perhaps lower than that. And a new analysis we're currently working on suggests limiting forgiveness to $10,000 or $50,000 wouldn't result in much improvement. A blanket student debt forgiveness is an effective stimulus because only a fraction of the money arrives immediately. Since borrowers pay back in monthly installments, the increase in income is mostly limited to the drop in monthly payments. The normal amount of student loan payments that are paid annually is around $70 to $85 billion, which is just over 5% of the $1.6 trillion portfolio. Further, with an interest payment pause in effect through September, loan forgiveness would not increase monthly incomes at all for the 90% of borrowers who are already not paying their loans. In addition, blanket debt forgiveness is an effective stimulus because it's regressive, as others have mentioned. The policy disproportionately favors higher income borrowers who are likely to save any additional dollars and offers little or nothing to those with less education who are most likely to be unemployed in the current crisis. Blanket debt forgiveness also comes with risks, namely moral hazard. If student debt were canceled without other significant changes to the student loan system, a reasonable person might expect the moral case for blanket debt forgiveness to be just as strong next year as it is now. The expectation that $10,000 or $50,000 or even all of their debt might be forgiven at some point could become an influential factor, driving more students to borrow more money than before. That expectation would lead many borrowers to be less sensitive to tuition increases, which would alleviate pressure on schools to rein in costs, especially graduate schools where student loan amounts are not subject to a strict cap. This could create a vicious feedback loop where students borrow more, incentivizing schools to raise prices, which in turn forces students to borrow even more and could lead to another even costlier round of debt cancellation. In terms of the cost, I've already mentioned $1.6 trillion for full cancellation. Capping forgiveness at $50,000 per person would mean canceling $1 trillion of debt, and capping forgiveness at $10,000 would mean canceling $370 billion. This conversation needs to be framed in the larger fiscal context. Debt could reach a record 108% of GDP by the end of this year and is on course to be twice the size of the economy within 3 decades. Recent borrowing to address the pandemic was the right thing to do in response to an unprecedented national emergency. But we've already borrowed over $5 trillion for COVID relief. With the economy poised to take off as vaccinations increase and communities reopen, policymakers must return to paying for the fiscal priorities they wish to enact. Now, I want to be clear. We should not ignore the very real challenges facing those struggling to repay their student loans. But the solution should be targeted to those who need relief, should ensure those who are able to pay back their loans do, include reforms to control higher education costs, and be fully paid for. A regressive policy like blanket debt forgiveness is not the solution. Thank you, and I look forward to your questions.
Thank you, Mr. Holt. And now we come to our final witness for this afternoon, and that's Dr. Looney. You're recognized for 5 minutes.
Thank you. Chair Warren, Ranking Member Kennedy, and members of the committee, thank you for the opportunity to testify today. Federal student loans impose a crushing burden on some borrowers, particularly those who enroll in programs where most students don't finish, where graduates are unable to find jobs, or where tuition costs are just too high. The borrowers who struggle are disproportionately from lower income families, first-generation students, and students of color. But that's only part of the story. Most borrowers, like college and graduate students in general, earn more, are better educated, live longer, are more likely to own a home, and come from more affluent backgrounds than other Americans. More than half of student debt is owed by households with a graduate degree. That's because programs where students borrow large amounts include professional programs like MBAs, law schools, or medical schools. While we often hear stories of borrowers who owe more than $100,000, the reality is that only 7% of borrowers owe that much, and many of them are white-collar professionals who can afford to repay their loans. After college, the typical bachelor's degree recipient earns significantly more than a worker with only a high school diploma, about $1 million more over a career. And that helps explain why about 36% of all student debt is owed by individuals in the top 20% of the income distribution. There's no income or wealth test for who can get a federal student loan, and affluent students are more likely to go to college, to go to a more expensive college, to complete a degree, and to go to graduate school. the typical student who grew up in a high-income family borrows about 27% more than a typical student from a low-income family. And that's among people who actually went to college. When you consider who goes to college in the first place, college students are even more privileged. And in contrast, borrowers who struggle with student loans are quite different. Almost 90% of borrowers who default have received a Pell Grant because their income and wealth was low when they applied to college. Almost 46% of defaulted borrowers went to a for-profit school, even though they represent only 9% of students. Half of defaulters never completed a degree, even though only 8% of student debt is owed by households without a degree. And that means that widespread debt forgiveness is regressive and disproportionately benefits well-educated, high-income households, expanding inequities rather than reducing them. Moreover, even modest proposals to forgive debt are staggeringly expensive. Forgiveness of existing student debt would cost more than the amount spent on programs like unemployment insurance, the earned income tax credit, or food stamps, cumulatively over the last 20 years. And in contrast to those targeted programs, the beneficiaries of student loan forgiveness would be vastly richer, whiter, better educated, and of higher socioeconomic class. A more effective way to target loan relief is through income-based repayment plans, which calibrate payments based on a student's income and forgive debt after a period of time. Today's income-based plans have flaws. Too few students enroll in the program because of administrative barriers. The benefits are heavily tilted to borrowers with expensive graduate degrees, even if they're high income. Relief takes too long for borrowers who have modest debts. We need to fix those problems because each year students borrow another $100 billion in federal loans. Even if Congress enacted significant new spending to reduce or eliminate undergraduate tuition at public colleges, most of that borrowing would continue because it was needed to finance living expenses, tuition at private universities, and for graduate and professional degree programs. Finally, when borrowers experience bad outcomes, it's largely the result of the low quality or high cost of the institutions they attended, rather than factors like family income, age, race, academic preparation, or other student characteristics. Congress could reduce default and delinquency and the outsized debt burdens of future borrowers by restoring a strong institutional accountability system and limiting the amounts that graduate and parent borrowers take out to reasonable amounts. There are thousands of institutions that provide upward economic mobility to their students. Federal aid could do more to enroll students at institutions that have good outcomes. The crisis in student lending can't be fixed administratively with a one-size-fits-all approach to forgiveness. Congress must decide which students, institutions, and degree programs taxpayers should pay for and which should be paid by the students themselves. Relief for existing borrowers could follow that same model. Federal aid should flow to those who truly need it, and not all borrowers need help. Thank you.
Thank you very much. Thank you, Dr. Looney. And now let's get to the questions. I recognize myself. I want to start by talking about the role that loan servicers play in our student loan system. Borrowers take out loans from the federal government to pay for school. And when it's time to collect, the government pays hundreds of millions of dollars to companies called loan servicers to manage the repayment process. Today, we have the CEOs of two of the largest loan servicers, Navion and FIA. Mr. Ramondi, your company, Navion, gets paid hundreds of millions of taxpayer dollars to service student loans. So I want to run through some of the highlights of Navion's record over the last decade. In 2013, the Department of Education's Inspector General found that your company, which was then called Sallie Mae, violated the terms of its contract by failing to report borrower complaints in its debt collection business. Is that correct? Mr. Ramondi?
Senator, I'd have to go look at the details of that back in that time frame, but
Okay.
Our job is obviously to comply with the rules and the laws, and we work very hard to make sure that we help all borrowers successfully manage their loans.
Okay, but this is a case where you didn't follow the rules, and I'll just enter that into the record, the actual report on that. In fact, in the last 7 consecutive Department of Education surveys, Navion has been dead last in borrower satisfaction. So I guess it's not a surprise if you wanted to hide consumer complaints. Let me ask this question differently. Attorney General Healy, you're one of the nation's leading consumer protection enforcers. You just heard the CEO of Navion say that they comply with the law. Is it your view that Navion does its best to follow the law and generally looks out for the interests of student borrowers?
Thank you, Chair Warren. The answer to that is no. And I think we've spent a lot of focus on forward thinking in terms of what needs to happen in terms of fixes. I support that as somebody who has done so many investigations and so many lawsuits and heard directly from borrowers who are actual people, not frogs in a pot, but actual people like the Deramir Perez's of the world coming to my office. I will tell you that we have received countless complaints about poor servicing practices. And, you know, you can blame Congress, you can blame the Department of Ed, you can blame for-profit schools, you can blame colleges and universities. The burden should not be on the borrowers, though, who repeatedly, through our investigations, both with respect to Navion and FIA, okay, were shown time and time again to have misled borrowers, to have made misrepresentations to borrowers, to have completely bungled up in catastrophic failures the way those loans were serviced, to the detriment of hundreds of thousands of borrowers. I spoke of the 200,000 of borrowers in Massachusetts affected by FIA alone. That's just one small story. And finally, with respect to Navion, just to remind folks, you know, the CFPB in investigation detailed and something that Navion reported, and I find it astounding. Their battle cry was to, quote, forbear them, make them relinquish the ball. Don't work with them on IDR, but just keep them going in these loans. And the second thing that Navion also represented in the past, arguing, quote, there is no expectation that the servicer, in this instance in Navion, will act in the interest of the consumer. That's a problem.
Thank you, Attorney General Healy. You know, in fact, we're not talking about a few isolated incidents. In fact, Mr. Ramondi, in 2016, 29 states investigated Navion for illegally, quote, paying call center workers based on how quickly they could get struggling student loan borrowers off the phone instead of actually helping them. You're currently being sued by 6 different states. In 2017, a federal audit found that Navion steered borrowers to repayment options that actually made it harder for them to pay back their loans so that call operators could save time and money. Navion even illegally overcharged the government for years to administer student loans to the tune of $22 million, but you've refused to pay it back for 8 years. So, Mr. Ramondi, if a person who worked at the Department of Education stole $22.3 million, they'd be fired. And if they were prosecuted for embezzlement, they could go to jail for 27 years. But Navion isn't a person, Navion is a contractor that never faces real long-term accountability. So can you explain why your government contracts haven't been canceled and why Navion has continued to reward you personally with nearly $40 million in compensation since 2014, even as these scandals pile up?
Well, Senator, some of these are allegations that are not true. And it's why one of the things, as I said,
public record.
No, they're accusations and not necessarily based on facts. But our goal is to help all borrowers, as I said, successfully manage their loans. And that's why my teams and I regularly listen to borrower calls. We're constantly making improvements to the way our programs work. We also deploy a very highly trained and caring team of professionals who help borrowers each and every day. And the results of this is that we are actually lead the industry in helping borrowers avoid default. And as you know, the devastating consequences that are associated with that. We we perform extremely well in enrolling borrowers in income-driven repayment plans. And we've used this insight that we gather from customers to be very innovative and develop new programs and solutions or processes that help more borrowers be successful. Recently, we rolled out an electronic e-sign program for income-driven repayment plans. And this was because we saw from our data and call listening that customers were having trouble completing the complex enrollment forms that are associated with income-driven repayment, 10 pages long, filled with jargon. And we took that system, developed an alternative, filled out the applications for them so that they would be accurate and complete, and sent them to them for electronic signature. We more than tripled the response rate. So very
Mr.
very
Ramondi,
performance.
I appreciate that. And I understand you're here to talk about the good things that your company has done. But you have been sued repeatedly, and you have been found to owe money that you have refused to pay. And this has happened over and over. And as I said, in the last 7 surveys, Navion came in dead last in satisfaction among student loan borrowers. So I'm glad for you to stand here and paint a general picture, but Navion made more than $500 million last year profiting off a broken system. The federal government should absolutely fire Navion. And because this happened under your leadership, Navion should fire you. But the problem is bigger than that. More than 40 million borrowers are trapped in a rigged game. They're crushed by debt. They're hounded by servicers and debt collectors. It is a massive drag on our economy, and we need a new approach. Canceling $50,000 of student loan debt would free millions of people from the traps that Navion and other servicers have laid for them. Thank you. Senator Kennedy?
Thank you, Madam Chair. Can you hear me now?
I can hear you.
Dr. Akers, can you hear me?
Yes, I can.
I want to understand the context. The money that our students borrowed, were they defrauded?
Well, some in fact were, and we have, for the most part, have made those students whole through debt forgiveness that's specific to their circumstances.
What about the majority of them?
The majority of them have not. I think the farthest you could go to say is that we've made the process complex so that there might be challenges for them to actually understand the obligation that they're taking on, but they were fully aware of the obligation that they were accepting.
Okay. Mr. Ramondi, can you hear me, sir?
Yes, I can, Senator.
Let me just say for the record, I hate virtual hearings. It's not Senator our chair's fault. That's not her fault, but I just hate them. I think they're very inefficient. Let me try to understand the context. You don't make these loans. Is that right, Mr. Ramondi?
That's correct.
The government makes these loans. Is
Yes.
that correct?
That's correct.
And where does the government get the money?
Borrows it from the U.S. Treasury Department.
Okay. When the government loans this money, are the majority of them honest loans, or have the students been defrauded?
Well, I think as Dr. Akers said, the majority, I would agree, the majority have been for the right purpose. There were some shady schools out there, and for the most part, those have been closed and those loans forgiven.
Okay. Have you ever borrowed money before?
Yes, I have.
Did you pay it back?
Yes, I did.
Would it be fair to say, why did you pay it back?
Well, for example, I took out student loans when I was in college, and that college degree afforded me an opportunity to get a good job. I went to a
right, but why did you pay the money back?
Because I had an obligation to pay it back, Senator. I had signed the promissory note, and I had an obligation to pay it back.
Did you consider it a moral principle? A
Yes,
moral
I consider-
obligation?
Moral and legal, yes.
Okay. Now, let me give you a chance to respond to, I know that you've been sued in a number of instances. Is there anything else you wanted to say in defense of your position on those lawsuits?
Yes, thank you. The programs, I think as you've heard from a number of the witnesses here today, are extremely complex, and the rules and regulations associated with them are complex. It's difficult for borrowers to understand why one loan is eligible for a certain program and why another loan isn't eligible for a program. We try to help borrowers through that process, and we try to help explain it. And
let me stop you,
Senator,
Mr. Ramondi. Let me stop you for a minute. So why don't we write simpler rules?
That's a great question. I think the programs and my recommendations in my oral testimony here was that we do need to make them more simple. Today, there are 60 different repayment options available to borrowers, 9 different income-driven repayment plans, all with complicated, as you can imagine, government-sounding acronyms that make it very difficult for borrowers to understand.
Okay.
And we think worse
Well,
amongst
it would seem to me that might be one thing that our subcommittee could work on is designing a student loan application process that looks like somebody designed the damn thing on purpose. I mean, these are supposed to be our best and our brightest who are borrowing the money. If they can't understand it, who the hell can? Let me move on, though. Dr. Baker, did I understand? Do you think the student loan program and the way we administer it is systemically racist? Is that what I understood you to say?
I was explaining the ways that a systemically racist society has made it so that people of color, especially Black people, rely on student loans at a higher rate than other people.
Do you think America is systemically racist?
Do I think that the American society has systemic racism? Yes.
Okay. What does that mean?
What does that mean? Broadly speaking, it means that we have sort of set up pathways in our society where different people have different opportunities and options that are before them. So as an example, it would mean that potentially one person in the world has 5 different options. They can go to college. They can take an inheritance from their family and start a business. They have all these sorts of different sets of options. What systemic racism does.
Yes, ma'am. Just give me, if you could, just give me your definition because I'm gonna run out of time here.
Oh, sure. Sorry about that, professors. So basically, systemic racism says that we have set up pathways so certain people of certain races get more opportunities and more benefits than other people do.
Okay. Do you think SMU is a systemically racist institution?
Do I think that SMU works within a racist society? Yes.
No, but do you think SMU is a systemically racist institution?
Does it have evidence of systemic racism? All universities do. Yes.
Okay. You did your graduate work at Vanderbilt. Do you think it's a systemically racist institution?
All universities work within a systemically racist society.
Oh. Yeah, but yes. I'm trying to understand.
Mm-hmm.
I understand your comment about America being systemically racist, but we have different institutions in America. So let me ask it more directly. Is SMU a systemically racist institution?
There is systemic racism at SMU and at all other institutions.
So you think every university is systemically racist?
I think that everyone who operates within the United States operates within a systemically racist system.
Okay. How do you, if we forgive all this student loan debt, how do you think we should pay for it?
I think there are several options on the table around potential increases for different taxes.
No, I'm asking you how you think we ought to pay for it.
Sure. I would say that that's not my area of expertise.
You don't have any, you just want us to forgive it and not worry about paying it back?
I would say that as an education policy expert, I can talk to you about those areas. I think there are a number of plans in place and that there are people on the committee who have talked about potentially raising the taxes on higher wealth individuals. There are options, but that is not my expertise. And you probably
I've gone way over. I don't want to, I assume that our chair is going to let us have a second round.
Of course, John. There'll be a second round.
No, you go ahead, Elizabeth.
All right. So, but there's absolutely going to be a second round. But now Senator Reed is up. Senator Reed.
Thank you, Madam Chairman, very much. And thank the panel for their interesting and thoughtful presentations this morning. Mr. Seeley, if I could direct a question to you, please, sir. The CARES Act and its subsequent administrative interpretations applies just to federal student loans held by the Department of Education and leaving out roughly 6 million borrowers with loans held by commercial and not-for-profit leaders. Has this been a source of confusion in your portfolio, and what options have you offered to these individuals that have not had the benefit of CARES forgiveness?
Thank you, Senator, for your question. And you really do highlight a great point and a disparity that exists out there in the federal loan space. When Congress did the various rescue packages, the CARES Act, it focused on the direct loan program while leaving out the FFELP program. And as I mentioned in my testimony, prior to the 2010-2011 academic year, 75% of all loans were FFELP loans. So there are things that ourselves and other servicers and holders of FFELP have done. First, we've made sure that our customers know that they're able to consolidate into federal direct lending. But it is important to note that that's not necessarily, it sounds simple to say everyone should consolidate, but there are individuals that actually would be harmed by consolidating. There's also individuals not eligible to consolidate. And that's why FIA's board of directors, we rarely take stances in federal policy matters, but our board voted and issued and signed a letter encouraging Congress to adopt what I'd refer to as FFELP parity. We sent it to the Pennsylvania congressional delegation. I'm very pleased that a number of members of our delegation, both R's and D's, signed on as co-sponsors in the U.S. House.
Thank you very much. And an additional question, there's a current pause on repayment, interest accrual, and wage garnishment. That's scheduled to end in September. So how are you preparing for the resumption of repayment, and how do you support borrowers in the transition?
Thank you, Senator. Another great question. So as you know, the federal forbearance is scheduled to come off September 30th. We have been dialoguing with the U.S. Department of Education on ideas that we believe might ease that transition. The CARES Act was very prescriptive about what servicers could do and could not do prior to borrowers entering repayment, dictating exactly the communications that could and could go out. Not sure exactly, since the CARES Act expired and we're now on extensions, how that ultimately will play out. But there are actions that we believe the department should authorize servicers to take prior to the portfolio entering repayment. For instance, we know individuals that were having struggles prior to COVID. And it's fair to assume that if someone was struggling prior to COVID, there's an even higher likelihood they're going to be struggling after COVID. So one of the things that we've encouraged the Department of Education to allow servicers to do is to reach out to these individuals. If we can get them on an income-based repayment plan prior to the resumption of payments, they'll be in a good situation to succeed. In many ways, this forbearance and this pause on payments gave them sort of a reset on their loan. It pulled them out of the delinquency ladder into current status, helped clean up their credit reporting. But we know who will struggle once it comes off. So we should do everything in our power to work with these individuals in advance of September 30th, and that's what we've been encouraging the department to do.
Well, thank you very much, Mr. Seeley. Thank you all, panelists. Madam Chairman, thank you for the opportunity. Thank you.
Thank you, Senator Reed. Appreciate it. Senator Tillis. Is Senator Tillis on? That's who I had up next. If not, Senator Scott or Senator Kramer or Senator Daines. All right, in that case, do I have Senator Van Hollen? Do I have Senator Smith? I feel like I'm calling the roll here in a void.
I know. Senator Ossoff, Madam Chair.
Yeah, thank you, Senator Warren.
I think Senator
to Senator Ossoff, and then I'll go.
You want to defer? That's fine. Senator Ossoff, you're recognized.
Oh, thank you, Senator Smith. I didn't realize you're here. And thank you, Madam Chair, for the opportunity. Thank you to the panel. And thank you, Madam Chair, for holding this hearing. And you and I have discussed this a number of times. There are so many people in this country, particularly young people, who struggle with the burden of student loan debt. And so many young families that are unable to take the next steps in their lives, whether that's home ownership or having kids or buying an automobile or starting a business or taking a risk on a job that may align with our passion, but could undermine our ability to service loan debt. And so I'm grateful to you, Madam Chair, for holding this hearing to explore the path forward on this issue. And I'd like to start, Dr. Akers, if you'd be so kind. Do you agree that a skilled workforce is in the vital United States national interest?
Yes, I do.
And do you agree, Dr. Akers, given your extensive scholarship and experience in government and in academia, that having a skilled workforce, having Americans who can perform skilled trades, who excel in science, technology, engineering, aerospace, math, who can operate complex machinery, who can design complex systems and interact with advanced technology is, one, a crucial way of enhancing upward socioeconomic mobility, and also, two, important to our competitiveness, where we have economic competitors globally who are investing heavily in increasing the skill level and competence of their own workforce.
Yes, I agree with all of that.
You know, one of the things, Dr. Akers, and I'd be curious for your view on this, is that we tend to talk a lot about four-year college degrees in this public policy debate, but sometimes don't speak with as much focus about skilled trades, vocational training, technical school, vocational training. Do you agree that investing in a highly skilled workforce not only benefits those people who access those skills, not only benefits the United States and makes us more competitive internationally, but also benefits America's private sector by supplying skilled workers who can increase corporate profitability and develop technologies that allow companies to sell newer and better products at lower prices?
Yes, I do.
So, Dr. Akers, I'm curious to get your view on the proposal to make technical school, vocational training, and training in skilled trades free for people across this country. I'm not asking at this time about the question of forgiveness of student loan debt. I'm asking whether you believe it would be a prudent use of public resources to make skilled trades, whether those are two-year degrees or vocational school opportunities, available to every American at no charge using a grant or scholarship system that is publicly funded rather than asking some folks who are pursuing those skills to take out loans.
I absolutely believe that we as a nation and states should continue to invest in sub-baccalaureate higher education after high school. I tend to prefer a voucher style subsidies so that people can take dollars and carry them to whatever institution will serve them well. And that is dissimilar in a way from a system that declares that institutions would be free of charge because of the central planning that would be required for that.
Dr. Looney, I'd like your view on the proposal to make tech school and vocational training free to Americans.
Well, I think the question is how much does it cost and who benefits and what degree of oversight is there? You know, one of the problems that plagues American higher education is that there's just wide variation in the quality of institutions and the value that they provide. And so one of the sources of the disconnect between how much we pay and how much value is provided is the degree of oversight and how the federal government invests money. So I think that the key question is the money being spent well, and how much oversight is there or where it's going?
Well, I look forward to continuing to engage with you on these matters. And I'll say that here's what I want to observe. We're talking about what I think is a pretty simple question. Should we invest in making access to skills free for Americans, which we've acknowledged in the course of this discussion, helps the United States compete, helps people achieve their dreams, helps companies become more profitable, We squander trillions of dollars on wars of choice. We squander trillions of dollars on bailouts and subsidies for investment banks, but it's difficult, it seems, at least at this hearing with the two distinguished panelists I've had the opportunity to engage with, to get a pretty straight declarative answer on what I think is a clear national interest in making access to skills free for Americans who want to develop professional qualifications that will help them get great jobs and earn more money. And with your indulgence, Madam Chair, I would just like to enter into the record letters that I have signed by the presidents of Spelman College, Morehouse College, and Fort Valley State University, as well as another letter from the president of Albany State University. These are historically Black colleges and universities in my home state of Georgia. And their reflections on how critical it is to make college more affordable, to reduce the burden of student loan debt and tuition payments for attendees at HBCUs, I think are vital for the record.
Without objection, so ordered.
Thank you, Madam Chair. Thank you to our panel.
Thank you, Senator Ossoff. Senator Smith.
Thank you, Madam Chair Warren and Ranking Member Kennedy, and I'm so grateful for all of the panelists today. So, canceling student debt is one of the most powerful tools that we have to expand the economy, to address racial disparities, and to help American families get back on their feet after the combined economic and public health crisis of COVID-19. So I am so glad to join the efforts of Senator Warren and Senator Schumer and others of my colleagues in both the House and the Senate to urge President Biden to cancel up to $50,000 in student loan debt. You know, here's the problem. Student loan debt is like a 1,000-pound weight that is holding Americans and our economy back. And that's only the half of it, because in fact, what's happening is that that weight is even heavier to carry if you are a person of color. So carrying that debt around means that you are unable to buy a house or a car or to take that job that you really want. And I think there's also a misconception that student loan debt primarily affects folks that are in the beginning of their earnings lifetime. And often we forget about those adults who have taken on student loan debt as they contemplate a career change or later in their life and are literally postponing their retirement because of student loan debt. So there is no one solution to this problem, but forgiving $50,000 in student loan debt is going to go a long way towards helping us achieve our goals of getting our economy going, helping families get back on their feet, and addressing the systemic inequity that we also see around student loan debt. It seems to me that this is going to mean a lot to a lot of people. And I want to just take a moment to hear from Ms. Perez. You are in a great position to help us all understand the impact of student loan debt and the impact of student loan debt relief in real time for real folks. I appreciated your testimony very much. And I'm wondering, could you just tell us a little bit, thinking about you and your family, your children that you're hoping to be able to put through college themselves, like just tell us a bit more about what this is really going to mean to you if we were able to get this kind of student loan debt relief.
Thank you. It will mean, sorry.
That's okay.
Aside of the emotional and mental stability that it will provide me and my children, because obviously I have these conversations with them, I will be able to support them more in their journey. I will be able to help also my family, which I keep hearing a lot of concepts and theories here. And it seems to me, and I cannot relate to anything or anyone that I know could relate to any of the things that are being said here. It is just not a reality. And being able to get this help will help us help our little ones and help our family get on their feet. It will help me also and mean a lot if I can afford my sister's college so that she's finally able to finalize her dreams. She's very smart. You know, it seems that it is a common thought that we are lazy, unintelligent, maybe English being second language and maybe struggling more than others to read a document seems to be thought as us not being intelligent enough, but that is not the case. And having this will also help me maybe purchase at home. Like you said, I would love to have a house in a safe area. I always had to like drive my kids everywhere, and no, I don't have a modern car. I have to ask my car permission to take me somewhere. So it will definitely allow me to make sure my children do not get discouraged, because they are getting a little discouraged. And I know with everything that happened also added to they did get like a little depressed. They were in the room, still in the South Bronx, yes, attending college, but still in the South Bronx, which sort of like hurt them a little bit. And if I'm able to help them attend the college of not their dreams, because we kind of like gave up on that as well, we are transferring them because we realized 1 year we cannot go into debt anymore. We cannot afford it. But I will be able to support them and make sure that they do not get discouraged. And I'm really confused with the poor jobs. I guess poor jobs being public service.
Yeah. Let me just ask, because I so appreciate your perspective, and I want to just ask about one thing. So you're saying basically that if you didn't have that student loan payment, you're going to be spending that money on helping your kids go to school, helping your sisters go to school, maybe even buying a house, being able to move your family along. But so tell me, let me just, and if I could, Senator Warren, I want to just, because there was a suggestion on the panel by some that this language of moral hazard, which seems to suggest that if you were going to get debts forgiven that you undertook, that that's going to somehow encourage you to take out more debt, or to that it's a sort of almost an encouragement to act irresponsibly. How do you respond to that?
I think of myself as someone who is very responsible. And like I said in my testimony, I did think that I was taking the right steps and avoiding taking loans because I knew my responsibility was to pay that loan. But I also hear people here talking about income driven. That program, I'm part of the program. And the problem with that program is that if you're not making enough money, it's like your monthly fees are very low, but then your balance increases. So you're paying, but your balance is increasing. And then I took on overtime and I worked long hours, but then now I make more money and now my monthly payments increase. And it's like I never get to be okay with like making my payments on time and doing everything that I know it's my responsibility. And I am not refusing to make my payments, and I am not refusing to take on my responsibilities. I just want to make sure that my children get the opportunity to attend school. And I finished my master's degree, and I really think that I finished my master's degree, then I should be able to and help my children to get their PhD and get receive more than what I received. I'm a little afraid how things are going, that I won't be able to do that.
I'm really grateful for your story and your testimony, and I'm out of time, way over time, but I want to just thank you so much for sharing that. I appreciate it so much. Thank you, Senator Warren, Chair Warren.
Thank you. Thank you. Thank you to our witness, and thank you, Senator Smith. Senator Menendez. Senator Menendez? I tell you what, I think Senator Menendez is almost here. So how about if I just start another round of questions, and when I finish, we'll go to Senator Menendez if he's appeared by that point. Let me start with you, Mr. Steele. Taxpayers pay your company, FIA, to manage the Public Service Loan Forgiveness Program, which we've heard a lot about here today. The program is supposed to forgive student debt for public servants, like teachers and nurses and members of the military, after 10 years. So far, about 225,000 people have hit the 10-year mark and applied for forgiveness. but a whopping 98% of them have been rejected. Now, no one should be let off the hook for the disaster that this program has turned into, but it is your job to ensure that people who have followed the rules get relief. The most common reason a borrower gets turned down is because your company says that they haven't made enough qualifying payments. But there are now multiple lawsuits and investigations that have found that you systematically undercount payments. Mr. Steele, just to take one example, the Education Department audits dating back to 2016 have shown that FIA's automated system creates errors and mistakenly disqualifies payments. Is that correct?
I'm sorry, Senator. I do not believe that that is correct. You know, anytime we identify an issue, whether it's a regulator like the Education Department or through our own control procedures, we actively investigate it and we work to make it right for the borrowers.
So then I don't think I quite understand your answer. Are you saying the Education Department audits dating back to 2016 did not show that FIA's automated system created errors and mistakenly disqualified people? Or are you saying it did show that, but you fixed it afterwards?
Senator, I'm not familiar with the audit that you're speaking. It was prior to the time that I was in my current role.
This is multiple audits that we're talking about here. Well, let me try another question, and let me turn this around again to Attorney General Healy. Mr. Steele says that he doesn't know about any problems at FIA. So let me ask you, Attorney General Healy, are these just isolated incidents, these audits that we've heard about? What has been your experience as you have investigated FIA?
Well, 5 years of investigation of FIA and other years spent investigating Navion. Both of these entities made a promise to the United States government that they could handle this work, as complex as they want to characterize it. And they failed miserably, and of course made boatloads of money for themselves in the interim, while borrowers are left high and dry. In our investigation specifically of FIA, what we found is that they repeatedly misinformed future teachers, firefighters, police officers, social workers, right? Because these were people who were looking to do public service work. They routinely misinformed them about the requirements of the program, about their status in it and whether they were qualified. They would delay processing applications. They would delay processing payments, which resulted in people being booted off in terms of eligibility. A question was posed earlier about fraud. I'll tell you all about fraud. It's why the Attorney General's office here and in other states have sued both of these entities for what we call unfair and deceptive practices to borrowers. FIA, for example, we found in our investigation was overbilling, double billing borrowers. The record is replete. As I say, we did enter into a civil settlement agreement with them. It is my hope and expectation that going forward with respect to both of these loan servicers, that the right measures be put in place. But the history through our investigation is loan servicing practices replete with deception to the severe, detriment of borrowers.
Yeah, well, thank you very much, Attorney General Healy. You have the on-the-ground experience with FIA and with the other loan servicers. It seems clear to me that FIA presides over a so-called public service loan forgiveness program that has proven itself nearly incapable of ever actually granting public servants any loan forgiveness. Mr. Steele, has the Department of Education terminated your contract or penalized your company in any way for its errors and mismanagement that have prevented teachers and firefighters and other public servants from getting the debt cancellation that the law provided them?
Senator, I'd like to answer your question at first by saying no, they have not, but also note that the majority of the rejections that you note, the 200 and some thousand rejections, over 75% are simply because the individuals that applied for forgiveness had not been in the program for 10 years. Now, I didn't write that requirement. The United States Congress and the U.S. Senate wrote that requirement.
Well,
So-
let me stop you there, though, if I can, Mr. Steele, because that's the fundamental question. Are you counting accurately? Because that's the one thing the federal government asks you to do. And as I see it, I think what the data show is that 59% of ineligible public service loan forgiveness applications were denied because they did not have enough qualifying payments. Borrowers aren't filling out these applications for fun. They're filling them out because their understanding is they've been writing checks for 10 years or longer. This is a program that's now 14 years old. And you're telling me that you could only find the payments for 2% of them?
So, Senator, first, as I noted just a minute ago, the primary reason that these applications are rejected is because they have not been in repayment of a qualified direct loan for 10 years. So, and then in addition, I would like to note, with all the errors that have been referred to, particularly with respect to Massachusetts, there are 25 individuals spoken to in that settlement agreement. Over the years of the investigation, we serviced 250,000 individuals in the state of Massachusetts. You know, we strive day in and day out to do our best for the people of Pennsylvania, for the customers we service. We advocate on their behalf for program improvements to increase those forgiveness rates that you note. And ultimately, yes, the Massachusetts Attorney General did find 25 individuals and we worked to make those corrected. In fact, those individuals have already been corrected.
The investigations are not simply about a random error rate. They're about systematic undercounting. And when you undercount the number of payments, that means that people don't qualify for the programs. Let me just give Attorney General Healy a quick chance to reply. We're way over time here. But Attorney General Healy, would you like to respond?
You know, I'm trying to be constructive here because this is about a forward going, what do we need to do to fix the system? But I want to be very clear. We found systematic failures both with respect to FIA and with respect to Navion. There is a reason, Madam Chair, that FIA has agreed to do a loan by loan, borrower by borrower audit just with respect to 218,000 borrowers in Massachusetts. If that doesn't signal that they know they had a problem, that's just Massachusetts. I don't know what else does. So, you know, there's a point about accountability, and then there's a point about what's going to happen in terms of why debt cancellation is imperative. But for FIA to suggest that it had the capacity to, or even now maybe has the capacity to engage in that kind of borrower by borrower analysis and processing, the reason those people were ineligible many times was because FIA lost the records, wasn't keeping track. So by fault, FIA created their ineligibility. And again, I think it's a shame for the borrowers
Right.
we're speaking of today.
And one of these investigations, I recall, said FIA left it up to the borrowers to figure out if there had been an error, rather than FIA having to get it right to begin with and put its own processes in place. Look, Mr. Steele, I think that FIA has demonstrated that it can't administer this program. I think the Department of Education should terminate your contract. But I think we've also established that teachers and firefighters aren't going to be any better off with Mr. Ramondi over at Navion in charge. This is an utterly broken system, and the solution is not more complexity and more incompetent middlemen. The best way to deliver relief to public servants crushed by student loan debt is to cancel their debt, and not after 10 years of bureaucratic torture and miscounted payments, but just to do it now. Senator Menendez, I believe you're with us now.
Thank you, Madam Chair. Thanks for holding this hearing. I appreciate it. I've been listening to some of the testimony and the back and forth. Let me turn to Mr. Ramondi. Mr. Ramondi, in 2017, when you were sued by the Consumer Financial Protection Bureau and the states of Washington, Illinois, and Pennsylvania for cheating borrowers out of their right to affordable loan payments, do you know how much money you made?
Yes, I do.
And what would that be?
In 2017, it was approximately $6 million.
$6.5 million, according to your company's filings. In 2018, when you were sued by the state of California for cheating borrowers out of their rights, do you know how much money you made?
Approximately $7.7 million.
And in 2020, when you were sued by my state of New Jersey for engaging in deceptive and misleading tactics when servicing New Jersey student borrowers, you know how much money you made?
Yes, I'm familiar, Senator. I'm very well compensated and I'm certainly appreciated. It was about $8 million.
Thank you. So over this period of time that I've referred to, you've earned over 20 million, and that's not even counting 2021. In that time, do you know how much money these lawsuits have alleged your company has illegally added to the debts of millions of your customers?
They actually have not alleged that yet, Senator.
Well, from what I've read, it seems that the answer is about $4 billion.
That estimate was that if 100% of all borrowers were in forbearance, that's how much borrowers paid. So clearly, that was not an estimate of how much we overcharged, Senator.
Well, let's put it this way: it's a lot of money, isn't it?
Well, that is 100% of borrowers who are student loan forbearance is a program that has been authorized by Congress and is an eligible repayment option for borrowers. In some cases, it's a very legitimate program. For example, you cannot enroll in an income-driven repayment plan if you're past due. So one of the tools, in fact, probably the only tool available to help a borrower enroll in that program is to grant them a forbearance, to bring that account current so that they are now eligible to enroll in an income-driven repayment plan.
Well, let me just say, if I was one of your shareholders, I'd be concerned that you pocketed $20 million in salary and compensation, but yet your company might be responsible for a couple of $1 billion to American families. If I was one of your customers, I'd be calling Secretary Cardona to cancel my student debt immediately. But as a U.S. Senator, the one opportunity I have is this oversight to drive home the review of entities such as yours. And I think the chair is right to do so. Let me turn to Ms. Perez. And thank you for talking about what student loan debt does to families like yours. If President Biden had forgiven your $35,000 in student loan debt in January, do you know how much you would have been taxed on that forgiveness amount?
No.
Yeah, that's okay. Most people didn't know that forgiveness was actually looked at the IRS by income. You would have faced a surprise tax bill of $7,700 at a minimum, which is pretty outrageous. Luckily, with working with Senator Warren and myself on the Finance Committee, we ended up with a provision of law that no longer has forgiveness be subject to income, so that individuals like yourself would not be subject to such a surprise tax bill. And I'm glad to see that we were able to do that. And your story is vividly an example of it. Finally, Dr. Baker, the federal government has been aware of the student debt crisis for some time now and attempted to alleviate through the student loan forgiveness program. So currently, the government has a couple of options for student loan forgiveness, including through the income-driven repayments program and the public service loan forgiveness program. Out of the 43 million borrowers who hold student loan debt, how many have been able to successfully obtain forgiveness through IDR?
An independent analysis, I think, estimated it at around 32 currently, 32 borrowers.
Out of approximately 2 million student loan borrowers who have been in repayment for more than 20 years, just 32 have ever qualified for loan cancellation. What's the approval rate for the PSLF program?
As Senator Warren mentioned, it's about 2% currently.
2%. That's an approval rate, not a rejection rate. So as of June of 2020, approximately 98% of borrowers who applied for PSLF have been rejected. So are IDR and PSLF providing the promised student loan forgiveness to broad swaths of student loan borrowers?
So it is not, they are not currently doing that. I think as several of the other experts on this panel have mentioned, there's significant amount of reform that is necessary in the IDR and PSLF programs in order to create the benefits that they were intended to.
All right, there's a lot of reform that seems necessary. Madam Chair, do I have another minute of time? Thank you.
Yes, go ahead, Senator Menendez. Take another minute.
My final set of questions. Today's hearing is not only important to highlight the impact of the crushing debt burden on America's working and middle class, but also the importance of broad-based forgiveness. Professor Yannalis, your research purports to show that canceling student debt accrues benefits disproportionately to the wealthiest borrowers. Or in other words, that's not a progressive policy. Is that fair to say? Is that a fair characterization?
Yes, that is correct, Senator.
To reach this conclusion, you viewed the benefits of debt cancellation in the context of the supposed generosity of these existing loan forgiveness programs for low-income borrowers, particularly IDR. Do I have that right?
Yes, that is correct.
And to be specific, to reach this conclusion, your research assumes every single low-income borrower has managed to enroll and stay in IDR for 20 to 25 years, having their debts wiped out as if they were eligible. Is that correct?
No, that's not quite correct. What we assume is we have different scenarios. In one of the scenarios, we assume that every borrower who would benefit would successfully enroll in IDR. In a couple of other scenarios, we assume that, for example, the Senate and the House passes legislation to make IDR programs more generous, and we actually find that that gives more forgiveness to low-income borrowers and borrowers of color.
Well, I think what I'm referring to is your recent op-ed, which you wrote in the Washington Post, which, quote, said, "We looked at what would happen if every borrower who would benefit from an income-driven repayment plan were put into one and forgave loans after 20 years." So out of the 43 million borrowers who hold federal student loan debt, how many have been able to successfully obtain forgiveness through IDR in the 25 years since it first became available?
So that's an extremely misleading question, because the way that these plans work is they provide forgiveness after 20 or 25 years. And the most popular of these programs only started in 2009. So we just haven't had 20 or 25 years. So there was an earlier plan called income contingent repayment. Very few borrowers took that up. So we would expect to
the bottom line, with all due respect, we have had 32 borrowers that have ever qualified for loan cancellation. You have a better chance of being struck by lightning than having your 20-year-old federal student loan canceled today. That doesn't sound very progressive to me. So I hope that President Biden will take advantage of this rare opportunity to bring relief to working families that need it the most. Thank you.
That's an extremely misleading statistic.
I think your analysis is extremely misleading, to be honest with you. Thank you very much.
Thank you, Senator Menendez. Senator Van Hollen.
Thank you, Madam Chairman, and thank you for holding this hearing and really diving into what has become the broken promises from the Public Service Loan Forgiveness Program. As a result, I think of a lot of complicated interpretation and a deliberate effort to mislead students. So, General Healy, I want to make sure I understand the settlement you reached with FIA as a result of your litigation. As I understand it now, if you're a student who had one of these loans and believes they've either been misled or that their accounts were mishandled, you've set up a process where an audit will be conducted and they will be remedied if it's shown that in fact there was a mishandling of the loan. Is that correct?
That's correct, Senator. And it's up to the borrower to apply.
Got it. So, Mr. Steele, you entered into this agreement. I assume you agree that that's a reasonable way to address these disputes. Is that correct?
Yes, it is, Senator. We welcome the opportunity, not just for the residents of Massachusetts, but any borrower across the country, to the extent that they have questions with what payments qualified, which payments did not qualify. We welcome the opportunity to review their account. We recently launched an updated portal that provides full transparency of every payment that was made and the detail as to whether the payment qualified towards forgiveness or did not qualify towards forgiveness. And if it did not qualify towards forgiveness, the reason why. And what this does is it gives consumers the information that they need to ask questions and submit a review case to us. And we have a process that we do as part of our day in and day out operations where we take a look at these review cases that come in.
Oh, well, thank you. So you anticipated my next question, which is if you agree that this is a reasonable process for the people of Massachusetts as a result of this agreement, will you agree that my constituents in Maryland, many of whom have experienced exactly the same kind of problems, will be able to essentially have exactly the same process that you've developed in the state of Massachusetts? Can we have equity here with respect to Marylanders? And many Marylanders, as you can probably guess or work in federal service given the proximity to the nation's capital. Can you tell me today that they will get the same setup and process as the people of Massachusetts?
Thank you, Senator. The setup may be a little bit different, but the fundamental process gets to the same outcome, that the individuals in your state, Maryland, as well as any state, have the ability, once they're enrolled in PSLF, submitted an employer certification form, they'll have the ability to see which payments counted towards forgiveness and which payments did not count towards forgiveness. If I may add, Senator, just a couple points that I'd like to make with PSLF. As a public service agency, FIA became engaged in this program. It was prior to my time at FIA, but my understanding was we looked at PSLF and saw it very similar to programs we administered just to the north of you in Pennsylvania. And what we discovered very early on is that the rules were very complex and the path to forgiveness was very narrow. And we've advocated time and time again from our very beginning of involvement to both the U.S. Department of Education as well as members of Congress across multiple administrations to simplify the program and make reforms that help borrowers. We finally got some progress in this last year in terms of having the Department of Education engage with us. We set up a task force and we got them to expand the criteria so that, for instance, borrowers were not penalized for things like prepaying their loans, that they could submit one form for forgiveness, whether for PSLF or TEPSLF, where before the department was requiring individuals to be rejected for PSLF before they could even apply for TEPSLF. And then we worked with the department on this transparency.
If the chair would give me a little more time, I'd sort of let you go on. I appreciate your answer. But,
sorry.
We're limited. Madam Chair, could I continue my question?
Of course you can.
Well, thank you. Look, I'm glad you mentioned that. In fact, Senator Warren has been one of the people pushing really hard, along with many of us, but she's been just a champion in pushing to reduce the complexity of this program. But the 98% denial rate is not due to complexity alone. That's the reason we're all here. It's because borrowers have not gotten the guidance that we certainly believe, and more importantly, the borrowers themselves believe that they should have received from those who are administering and servicing these loans. So it has taken what has admittedly been a complicated process and made it worse. Mr. Ramondi, I'm going to submit to you this case of one of my Maryland constituents. He's an environmental scientist at the University of Maryland, never missed a payment for 10 years, made sure he was on the income-driven repayment plan. He was led to believe that would put him on the path to PSLF. We've spoken to him. He never received counseling from Navion about the terms for forgiveness of his loan. Navion is the holder of his loan. He made his 120th payment, which was the final payment, and only then learned that because he had a family federal education loan, FFEL loan, he wasn't eligible for forgiveness because he was on the IDR and because he was put in forbearance more than once when Navion failed to process his income certification on time. His balance ballooned. In fact, today he owes $29,000, which is $5,000 more than he owed when he started paying his loans. So here's a situation where somebody who was paid on time every time, it turns out never received any guidance from Navion. Don't you agree that this kind of miscommunication is a significant part of why we have a 98% denial rate, and why people like my constituent are put in this kind of position?
Well, Senator, thank you for your question. There's a lot of complexity here with individual borrowers, and to your point, you're actually raising a really good point, is that public student loan forgiveness applies to only certain types of loans. It doesn't apply to FFELP loans owned by companies like Navion. It doesn't apply to FFELP loans owned by the Department of Education. There are also certain types of payments that you have to make. You have to make on-time payments. You can't be late. You have to make full payments that are required under an eligible plan. I don't know the individual circumstances of this borrower's case, but I'd certainly be happy to look into it on behalf of you and your staff, and see what we can do to resolve any challenges here. One other point I would just make is that forbearance does not make you ineligible for qualifying for the program. It just doesn't count as a payment because it's not a payment. But again, all of these rules and all of these requirements are set by the Department of Education based on, the statute. So, I think, as Mr. Steele was indicating, and I have said, and even Ms. Perez had said, it's a complicated program. And, she's seen her loan balance increase as she's in this. That's why we recommended today in this hearing a forgive as you go option. So some of these programs are easier to understand and easier to qualify for.
Right. My final follow-up here is, as I understand it, Navion does not, you don't service the PSLF loans, correct? That's done by.
Correct.
So here's the situation. If this individual had discovered that he was in the wrong entity with Navion, he would have been transferred to FIA, right?
Well, in this particular case, Senator, we would have advised the customer to consolidate their loan into a direct loan so that it would have been eligible to participate in the public student loan forgiveness.
Right.
The loan type he had was not eligible, and we don't service those loans as you.
And then you would have lost that loan. Here's the situation.
We would have lost that loan, but we still recommend that process to all customers.
That's the issue, right? Because it's hard to believe this guy, my constituent, is a bright guy. He's paying for 10 years to Navion. And only after he's made his final payment, after conferring with Navion, then he discovers he's no longer qualified for the student, the public service piece, after 10 years with Navion. Nobody told him, and I can assure you he asked. And it clearly was not in Navion's interest to let him know, because you would have lost the loan. But look, I'm going to send this to you, but I have to agree that it is complicated, and we are working on that. But 98% denial is not only the result of a complicated program. So
I'd be happy to take a look at it and report back to you, Senator.
Thank you. Thank you, Madam Chair.
Thank you, Senator Van Hollen, and thank you all. So we've got a few more questions to wrap this up. We've heard a lot today about canceling student debt and who would benefit, and I just want to do a couple more around this. First, I want to ask the question about who the student borrowers are. Borrowers and graduates are not the same. About 40% of borrowers don't make it to a degree. So they are paying off student loans on a high school graduate's salary. And as Dr. Yanellis' research showed, about 20% of borrowers went to for-profit colleges, and they are much more likely to default on their debt. Dr. Baker, let me just ask you, some of your colleagues on the panel have argued that forgiving student debt disproportionately benefits wealthier borrowers. Is that correct?
So I would argue that that's correct based on the simulations that they have done. I think that there are other pieces that should also be taken into consideration. If we think about the $50,000 plan as a quick example, what you have to keep in mind is, let's think about the Department of Education just released a report that says that if you cancel $50,000 in loans, 84% of the borrowers would have all of their debt wiped out. So if you do that, then we have to think that that means 84% of those borrowers, right, they have less than $50,000. What do we know about those people? Those people are more likely to have less wealth. Those people are more likely to be Black and brown. The simulations that my colleagues are talking about often don't either take into consideration race, or they make assumptions that are not quite as in line with the way that sort of loan repayment works practically. That can sometimes underestimate the effects for wealth generally, but also particularly racial wealth gaps.
Okay, that's very helpful when you make the point about income and wealth. You know, the analysis, at least that I've seen from others on the panel, looks only at income. But if you consider all assets, you see that people with student loan debt have lower total wealth. And there is a massive racial disparity in who has debt and how much debt they have. So the primary beneficiaries of debt cancellation, as Senator Schumer and I have proposed, aren't lawyers or doctors with fancy degrees. They're people who are trying to break into the middle class and are being held back by massive debt burdens. So the new data that's been released by the Department of Education for today's hearing shows that canceling up to $50,000 of student loan debt, as you rightly said, Dr. Baker, this is going to relieve the debt burden entirely for 36 million people. And as you've said, we have to think about this as a racial justice issue. Black and brown students take on more debt to get their degree, and they have to get more education to overcome discrimination in the job market. Black students are nearly 20 percentage points more likely to take out federal student loans than white students. And then when they graduate college, they end up earning about 20% less than white graduates. These are racial disparities that can't just be wished away. Fixing repayment programs is not enough. We've heard a lot today about the problems with our current repayment programs, such as income-based repayment. And I think all of us here today, however you got here, agree that we need to reform our repayment system to work better for borrowers. But Dr. Baker, let me ask, in your view, would improving programs like income-based repayment or the public service loan forgiveness, is that an adequate solution to the debt crisis?
I would say no. I would say that the amount of reforms that most of us are talking about when we try to think about the places that we want to have these programs be similar to, so like Australia is a great example, the amount of reform that it requires will take years to implement within the United States. And during that time, people will still be suffering. That's why I talked about cancellation being a tool that supplements reform, so that we could work both towards reforming the system, but also trying to redress the harms that we've already done to current borrowers.
And as earlier folks were talking about, they're talking about a recent report that came out that said only 32 people have ever achieved forgiveness under income-based repayment. That's not 32%. That's 32 human beings out of an estimated 2 million borrowers who could be eligible right now. It is shocking, and it really drives home how much of a disaster these programs have turned out to be. Mr. Looney, I thought, put it very well when he said, you talk to people who are burdened by these debts, and they just feel hopeless. There's an oppression there, and I couldn't agree more. We've tried piling one complicated program on top of another to help people manage their debts. I think today we should just declare that's been a complete failure. It's time to go big and to go simple. Wipe out a big chunk of this debt and give people an opportunity to start over. I think this is crucial. And then one last thing, I just want to see if we can tuck in here. Sometimes there's some confusion around the Higher Education Act and the president's authority to forgive student debt. So Attorney General Healy, I just wanted to give you an opportunity to weigh in on this. What's the legal consensus on whether President Biden has the authority to cancel student debt through executive action?
Thank you. It is absolutely the case in our view, and there is legal consensus that the President of the United States has the legal authority to cancel student debt. I can give you chapter and verse of 20 U.S. Code, Section 1082, and the various sub-provisions, but having analyzed this, that is our view, and I believe it's a consensus view out there that the President may authorize Secretary Cardona today to compromise and cancel these debts.
Thank you. I appreciate it. You know, President Obama canceled debt for more than 70,000 students that have been cheated by for-profit colleges. President Trump and President Biden have both exercised their authority to modify student loans by pausing payments and canceling 100% of the interest that accrues during this pandemic. As we speak, the Department of Education is currently canceling about $5 billion of debt per month in interest. President Biden's legal authority is absolutely clear. So we've heard a lot of facts and figures today about student debt. I just want to give Ms. Perez the last word here. Ms. Perez, you told Senator Smith what canceling $50,000 of student debt would mean for your family, and it was a very important piece of testimony here. Can I just ask the other side of that? What are you most worried about with payments on student loan debt resuming this fall?
Thank you. Now I have my twins in college. Now I'm going to have more bills to pay. Last week, I called my provider and I asked a few questions, but I'm not really clear. I have to call again and see how my payments will be in September. I am just afraid that I won't be able to support my children and they will have to take more loans and go more into debt because I've been through it. I'm going through it, and I know what that would mean for them. And it's just my anxiety is escalating rather quickly.
I understand, and I appreciate your coming here to talk with us about it today. I know this is hard. You know, this student debt crisis is not about numbers on a page. It's about real people who did everything we told them to do, took out loans to get an education, secure a spot in the middle class, and who are now trapped in a cycle of debt that is about families. And that's the point you make, Ms. Perez. This is about our families. Management of the student debt crisis is a massive failure from top to bottom. Student borrowers shouldn't be left holding the bag because of the failures of loan servicers and bureaucrats. President Biden can cancel $50,000 of student debt with the stroke of a pen today. He can start to close the racial wealth gap, and he can relieve the burden on borrowers and on our economy. So that's the end of our hearing. Thank you to all of our witnesses for being here today. Thank you for providing testimony. Before we go, I want to enter in the record a letter signed by more than 400 organizations calling on President Biden to cancel student loan debt by executive action. And for any senators who wish to submit questions for the record, those questions are due 1 week from today on Tuesday, April 20th. For our witnesses, you have 45 days to respond to any questions after that. So thank you again for being here. And with that, this hearing is adjourned. Thank you.